I'm Alan Kenny, Editorial Director with REIT.com, and we're in Washington, D.C. at the Marriott Marquis Hotel for REITWise 2016, NAREIT's Law, Accounting, and Finance Conference. I'm joined by Rosemarie Thurston, partner with Alston Bird. So, Rosemarie, here at REITWise, you moderated a panel on the public non-listed REIT market. How in general would you describe the state of the PNLR market right now?
Well, great question. So NAREIT chose for the theme of our panel, which they're doing for all of the panels, they choose a song. And so the song that they chose as thematic for public non-listed REITs right now is Jimmy Eat World's The Middle. So we kind of feel like this industry really is in the middle, but maybe it's about to emerge. It's really going through a transformation right now, largely driven by a couple of factors. Mostly the regulatory environment, and so we can talk about that. But basically, the FINRA rules, which will be adopted April 11th, become effective April 11th, are really going to change the whole paradigm on customer account statements, which will create a lot more transparency in the industry as to valuations of those securities. And then the second factor is the largest fundraiser in the industry, AR Capital, has pulled out of the sector. They were responsible for almost $19 billion of capital raised in the last 4 years. So how do we replace that? How do we react to that? The industry is really trying to adapt in that way. So caught in the middle.
You mentioned transparency. That's something that FINRA is obviously trying to work on within the PNLR sector. Mm-hmm. How would you assess the impact of those efforts so far?
It's really huge. So historically, customer account statements had just the $10 per share price on the statement for as long as the REIT was raising money, and then 18 months thereafter. So investors didn't know for a very long time what that security was actually worth. The new rules are going to require that customer account statements from day one cannot show the $10. They'll have to use a net investment amount. So the net investment amount will deduct that sales load and an allocation of the organization and offering expenses. So as opposed to showing $10 day one, they'll show something like $8.50 to $9. And then a year, 2 years, and 150 days after the escrow break for the offering, a valuation based on an appraisal of the assets of the REIT will go on the account statement. So much earlier in the cycle where investors actually have a value for that security, and early on they'll understand where that load is. And so as a result, we're seeing a lot of product innovation to sort of solve for some of that difficulty with the customer and financial advisor relationship. So we think that ultimately what that's going to do is the A shares, if you will, the old $10 with the full load up front will probably go out the way of the dinosaur, and we'll see the new T shares become the standard security in this sector. And the T shares have a small upfront load and then an ongoing trail that comes out over time.
One last question. Do you see any best practices right now that are emerging that you could imagine seeing as being standard operating practices in the near future?
Yeah, I think these valuations, it's really been fantastic. So while the FINRA rules just basically have a loose framework for what needs to be involved in that valuation, the industry has taken it upon themselves to come up with best practices. So the Investment Program Association put out some guidelines for valuations. Those guidelines dictate that there be a valuation committee. The independent directors are the only members of that committee. The independent directors on that valuation committee will oversee the process. The process will involve an expert who will value the real estate and provide that valuation to the valuation committee. The valuation committee analyzes it, makes a recommendation to the full board, and then the full board will then approve that value. Also, when that value is approved, it's disclosed to the public in a report that will have a lot of detail around what are the assumptions that went into that, what were the cap rate assumptions, sensitivity analysis, if the rates were to change, what would that valuation actually look like, and then some real good disclosure about this is a point in time. Many times the valuation's done while the REIT is still in a pretty early stage of its development. So the investors, I think, are now going to understand this is a moment in time that gives me a value, gives me some sense of what that security is worth, but these securities are intended to be bought and held for the duration of the investment, which should be 8 to 10 years.
Well, Rosemarie, thank you so much for your time.
Pleasure.
And for more on this and other REIT news and analysis, be sure to visit REIT.com.